Hello, my name is Charles Maltby, CEO of BW Epic Kosan, and I'm joined today by our Chief Financial Officer, Uta Urbaniak-Sage. We would like to welcome you to our call to discuss our results for the second quarter. I would like to highlight that the webinar is being recorded for later viewing and allow for questions to be asked any time via the Q&A window. We will answer your questions at the end, either verbally or via written response, or offer to take offline separately later. I would also like to draw your attention to the disclaimer on this slide. Our improving headline revenue and forward cover rates have been outweighed during the quarter by a seasonally weaker spot market and higher voyage and operating costs, leading to second quarter net profit of $3 million, minus 21% year on year. Our fleet, which includes pressurized, semi-refrigerated, ammonia and ethylene capable vessels, earned a second quarter revenue of $86.6 million, a 6% increase from a year ago. Time charter earnings per calendar day in the quarter increased by almost 4% year on year to 11,227 per day, driven by our evolving mix of vessels and modest improvement in the underlying market. Our operational expenses, that's OPEX, increased by 14.6% to 5,446 per day on account of COVID-19 and global inflationary pressures and one-off costs related to exiting vessels. During the quarter, we have completed over 750 crew changes, many still impacted by COVID-19, and are working to normalize crew transfers and manage associated inflationary costs. Our G&A is reducing as we benefit from economies of scale following the merger, with the second quarter down by almost 13% year on year. Our fleet operational utilization during the quarter was 91.7%, which was 1.8% higher than last year. Our lost time injury frequency, LTIF, rate this quarter was 0.92, an improvement from a year ago. Our year-on-year emissions have increased by 5.4% with an AER of 24.13 of CO2 deadweight ton miles because of increased utilization and consequential fuel consumption, partially offset by investments in carbon emission reduction, such as silicone paints and other energy-saving initiatives. We are also involved with projects that support wider decarbonisation, such as shipping related to carbon capture and storage. Many of our vessels are capable of carriage of future clean fuels, including ammonia, and with modest investment, other specialty gases such as CO2. Our strategy remains to focus on the LPG, petrochemicals, and specialty gases sector, continuing to grow the average size of our fleet and maintain an average attractive age. As of today, BW Epic Kosan operate a world-leading fleet of 73 vessels, ranging in size from 3 to 12,000 cubic meters in the pressurized, semi-ref, and ethylene-capable sectors. We aim to deliver to our customers the best solution for their transportation needs, along with exceptional service and operational standards. Zero harm drives our safety culture and commitment to operating without accidents and achieving our environmental goals. Our organization has significant commercial and technical capability across pressurized semi-ref, refrigerated gas, and petrochemical transportation, and the flexibility and capability to meet our customers' needs around the world. This operational and technical experience is enabling us to work alongside industry partners to not only reduce emissions, but to also explore projects that support wider decarbonisation, such as shipping related to carbon capture and storage, CCS. LPG remains a primary cargo for which we are an integral part of the supply chain, both for distribution over the last mile or regionally around the globe, primarily into domestic or residential markets, typically for use as a cleaner energy in cooking and heating. We are also actively involved in the transportation of petrochemicals, such as ethylene, propylene, butadiene, and VCM. The company is headquartered in Singapore, with Copenhagen covering our regional activities in the West, alongside offices in Manila and Tokyo. Turning to vessel supply. BW Epic Kosan has pressurized, semi-refrigerated and ethylene-capable vessels as part of our fleet. There are a total of 349 pressure vessels on the water, which includes 3 new builds that delivered during the quarter. The International Pressure Vessel Order Book has 6 more new builds scheduled to be delivered in the second half of 2022, 5 in 2023, and 3 in 2024, a total of 103,500 cubic metre. This represents, over the 3 years, a total of 5.7% increase in the existing fleet capacity. There are 2 7,500 cubic metre CO2 carrier new builds scheduled for delivery in 2024, which are being specifically built for carbon capture, utilisation and storage in Northwest Europe. Looking now at the semi-ref and ethylene-capable sectors, there are 3 semi-ref vessels which are scheduled for delivery in 2023. This new build capacity of 15,000 cubic metres equates to a 3% increase in the existing fleet capacity. There are also 3 7,200 cubic metre dual-fuel ethylene vessels under order for delivery in 2024, which represent a 2.3% increase in existing fleet capacity. The new build order book must also be measured in the context of the potential scrapping pool. In the international pressure fleet today, there are 17 ships totaling approximately 60,000 cubes that are aged 30 years and older. These potential scrapping candidates represent 3.3% of the existing fleet capacity, which offsets some of the new build fleet capacity growth. In the similar size segment, there are 6 non-ethylene semi-ref vessels and 3 ethylene vessels that are aged 30 years and older, equivalent to 3.2% of existing fleet capacity. So to summarise, for the combined smaller gas carrier sectors, our expectations are for 2.8% and 1.4% net fleet growth in capacity before further scrapping in 2022 and 2023, respectively. Global LPG trade has remained robust despite high energy and feedstock prices and supply disruptions. Drewry's latest research has estimated that seaborne LPG trade in 2022 will increase year on year by 3.9% to 116.9 million tonnes, with a related 4.1% growth in tonne-mile demand. Similarly, the global seaborne olefins trade, that is petrochemicals such as ethylene, propylene, butadiene, and VCM, is expected to increase from 16.1 million tonnes last year to approximately 16.4 million tonnes this year, a year-on-year gain of about 1.4%. LPG seaborne exports from the United States exceeded 14 million tonnes in the second quarter, a 15% quarter-on-quarter and 5.9% year-on-year gain. Europe-bound cargoes from the US increased by over 40% quarter-on-quarter as the region sought to replace Russian gas. In Asia, the main demand for LPG comes from China, India, Japan, and South Korea, who together imported over 15 million tonnes in the second quarter of 2022, also up by about 1.5% year-on-year, but down 8% quarter-on-quarter. There has been a reduction in US cargoes bound for Asia compared to the previous quarter, from 50% to 47% of total volumes. China's LPG demand is driven by its petrochemical sector, with producers favouring LPG over naphtha in a high oil price environment. On the other hand, Indian LPG imports, which are driven by demand from residential users and the retail sector, have dropped by 11.3% quarter-on-quarter due to the higher energy prices. Turning for a diver now in the smaller gas carrier demand, LPG exports from the USA on such vessels as ours increased by 2% quarter-on-quarter, with the Caribbean and Central American countries accounting for 75% of these exports. In the East, LPG imports into Bangladesh fell by 13% compared to a strong first quarter, but gained 22% year-on-year, indicating firm underlying domestic demand. Imports into Sri Lanka were impacted by the country's economic crisis, with volumes dropping 57% quarter-on-quarter and 60% year-on-year. The Asian ethylene and propylene markets remained subdued on account of weaker margins and lower downstream demand. The easing of COVID-19 restrictions in China has not yet had the positive impact expected, where China's ethylene and propylene imports in the second quarter were both lower by 11% Q-on-Q and about 30% year-on-year. To look now at the overall picture, the overall supply-demand fundamentals have resulted in firmer freight market levels, improving our underlying revenues and a modest increase to our forward cover rates. Quarter on quarter, there have been gains across all sectors, plus 10 to 14% for the smaller 3.5 to 5,000 cube vessels, and plus 7 to 10% for the larger 7.5 to 11,000 cubic meter vessels, and plus 6% for the ethylene 8,250 cubic meter sector. However, the pressurized 11,000 cube and ethylene 8,000 cube vessels remain below long-term average levels, with supply and demand fundamentals supporting further improvement. Our business is globally diversified. At the end of the quarter, we had 9 vessels operating in the Americas, 42 in Europe, Middle East, Africa, and 21 in Asia. In the second quarter, we averaged nearly 5 loading operations every day across our fleet, loading 1.4 million tons, and was involved in just under 1,000 cargo operations in 204 different ports. Our cargo mix is split about 48 to 52% between LPG and petrochemicals, with 1 vessel in the growing ammonia trade. This diversity in geography and commodity has widened with the formation of BW Epic Kosan and provides options for our fleet and relative stability in our earnings floor. Ship-to-ship or STS operations are an important part of our global business. During the second quarter of 2022, our vessels carried out 81 STS operations, which is equivalent to almost 1 operation every day, and 8% of our global cargo operations. Developing economies with high LPG demand growth rates are often constrained by infrastructure, shallow waterways, and limited storage facilities. Thus, the use of our vessels to complete the last mile delivery from larger tonnage, such as VLGCs, make the pressurized ship an important part of the global supply chain. In Asia, we continue to provide LPG fueling operations for the increasing number of LPG dual fuel VLGC vessels. We ended the quarter with 65 core vessels with a total capacity of 473,940 cubic meter and an average size of just under 7,300 cubic meters, up 3.3% year on year. We have also continued to run 7 additional vessels with a total capacity of 57,000 cubic meter under our commercial management. We continue to fine-tune our fleet to focus on modern, larger vessels. When it comes to the trading of our vessels, we are keen to work alongside customers over the long term and offer flexibility between time charters, voyage charters, contract of affreightment, so-called COA, and spot contracts. During the second quarter, the fleet traded under time charter for just under 65% of total voyage days, compared to 64% a year ago, and under COA for 10.5% of total days, down from 15.3% a year ago. During the second quarter, the fleet experienced 221 technical off-hire days, which included 4 planned dry docks. We incurred 9 days off-hire related to COVID-19 countermeasures, such as deviation to a port where transfers are possible, waiting time for quarantine and test results, port process, and connecting flights. For the quarter, this resulted in fleet availability of 96.3% and an operational utilization of 91.7%. I would now like to hand the call over to Uta to step through our financials.
Thank you, Charles. Starting with our P&L. In the second quarter, we generated TCE revenues of $67 million, about the same level we recorded in Q2 last year. Our TCE earnings per calendar day were $11,227, 3.5% up from the $10,848 we achieved in Q2 2021, reflecting an improved market and the increase of our average vessel size as we redelivered smaller vessels and took delivery of larger sized vessels. Vessel operating expenses increased from $28.6 million to $29.3 million year-over-year, and include one-off costs related to exiting vessels, as well as pandemic and inflationary expenses. Operating expenses also increased on a per calendar day basis from $4,754 to $5,446 year-over-year. Charter-in costs increased from $1.1 million to $3.1 million year-over-year due to the conversion of bareboat charter contracts of 4 vessels into time charter contracts and 1 additional chartered-in vessel on a time charter basis, offset by the redelivery of 4 vessels in the first half of 2022 that were chartered in on a bareboat basis. As of 30th of June, we had 8 ships on inward charter arrangements, 1 on a bareboat basis and 7 on a time charter basis. G&A expenses for the second quarter decreased from $7.8 million to $6.8 million year-over-year, reflecting cost synergies following the business combination that completed in March last year. On a per calendar day basis, they decreased by 12.9% to $1,007 year-over-year. Finance expenses decreased from $5.1 million to $4.8 million year-over-year due to lower outstanding debt across our fleet. As of the quarter end, we had interest rate swaps in place for $265 million at a weighted average interest rate of 1.15%, covering 75% of our bank debt in an environment with rising interest rates. We achieved an EBITDA of $26.5 million and a net profit of $3 million for the quarter. This translates into a year-to-date return on equity of 5.2%. Moving on to the balance sheet. The book value of the fleet at period end is $845 million, $65 million below latest broker valuations. Our total debt, including finance lease liabilities as of 30th of June, was $438 million. Including our cash position of $49 million, our net debt is $389 million, down by $25 million from the start of the year to 46% of book value, which we regard as a conservative level. I will now hand back to Charles for a summary and outlook. Thank you.
Thanks, Uta. To summarize, the weaker second quarter results were impacted by higher costs related to one-off vessel exit costs, dockings, bunker fuel, inflation, and COVID-19. In a seasonally weaker market, the supply of new build vessels in our sector remains balanced, with the small gas carrier fleet forecast to grow by 2.8% over 2022 before any further scrapping. The order book for larger LPG segments has been running at high levels, but we note that inflationary pressures are leading to increased shipyard new build costs for all sizes, alongside the high technology costs associated with dual fuel LPG or LNG. Forecast seaborne LPG commodity demand growth for 2022 at 3.9% is positive, and we expect earnings momentum to recover as we exit summer seasonality. There is uncertainty in the market on account of geopolitical conflicts, high energy prices, recessionary forces, and negative margins in the petrochemical industry. However, we are working to manage these impacts through the diversity of geography and commodity available to our fleet, and continuing to deliver efficiency to our combined G&A and OPEX levels. We are also placing forward cover at modestly improving levels. As of the 30th of June, the company was approximately 49% covered for the year, with 6,426 voyage days covered at an average daily time charter rate of 11,843, leaving about 6,800 calendar days open for the rest of the year. BW Epic Kosan has the scale and operational strength for future success and is working to further improve earnings potential, deliver operational synergies, increase our efficiency, work towards the IMO emissions targets for 2030 and beyond, and support wider decarbonisation by involving ourselves in projects such as shipping related to carbon capture and storage. Many of our vessels are capable of carriage of future clean fuels, including ammonia, and with modest investment, other specialty gases such as CO2. We have now reached the end of our presentation. Hi, Uta. Do we have any questions available?
No, there are no questions at the moment.
Okay, dokes. Well, look, thank you very much to everybody for taking part today. If you have questions you'd like to follow up with offline, please send them through to Uta or I, and we'll get back to you directly. But in the meantime, thank you very much to everyone for making the time to join and listen today. We appreciate your interest in the business. We look forward to catching up in November for our third quarter 2022 earnings report. Thank you very much.